Vanguard Exchange Traded Funds, or Vanguard ETFs, are a class of funds offered by Vanguard. ETFs combine the diversification of mutual funds with a lower investment minimum required. Vanguard also offers real-time pricing. ETFs are traded the same way that individual stocks are traded. In a way, they're similar to that of the widely known SP 500, which holds the top 500 companies in the United States. In this video, I'm going to give you the top 5 Vanguard ETFs that you must buy and never let go of. But before we proceed, a like on this video and a subscribe to this channel is truly appreciated. The first Vanguard ETF that I'll be discussing, and probably my most recommended, is the Vanguard Total Stock Market ETF. VTI aims to track the overall performance of the US stock market, and as a result, it now owns a small portion of each of the 4,100 equities listed on the stock market. The Total Stock Market ETF stores a large number of stocks, so it's divided into large, mid, or small cap companies, depending on their market value. There's a minute manager risk involved because this is a passive index fund ETF, which is actually purchased and sold. Statistics show that this type of ETF has an 80% success rate, and over the past 50 years, only 10 investors ended up with a loss. Investing $10,000 in this ETF for 10 years can turn it into $63,000. This is because of the 32% one-year return, 15% three-year return, 16.8% five-year return, and a 16.6% 10-year return. However, a financial crisis caused the largest loss in VTI in 2007, and it had a maximum drawdown of 50%. It took 3 years and 1 month for them to recover. As a result, the annual cost of owning VTI is relatively low, which is about 0.03% or 30 cents for every $1,000 invested. The Vanguard Total Stock Market ETF is rated a 4 on the risk potential scale as it invests only in stocks. As VTI tracks the entire stock market, the sector breakdown will then be dependent on the company's size. Because the largest companies are in the technology sector, we can see that it accounts for 25% of the fund, followed by healthcare at 13%, financial services at 13%, consumer cyclical at about 12%, and communication services at 10%. The Vanguard Total Stock Market ETF is for anyone seeking to mirror the returns of the whole US stock market in a very passive way. Because it's weighted by market valuation, the top 10 accounts form a large portion of it, and it will generate the majority of the profits. The good news is that they're all solid businesses, with a stronghold in their respective industries. As a result, it's quite improbable that they'll disappear anytime soon. However, if you already own VTI and want to diversify your portfolio a bit more so it isn't so heavily weighted in tech businesses, the Vanguard Real Estate ETF, VNQ, is a good option. This ETF is set up to track the broad US real estate market and is made up of 171 different stocks. Just like the Vanguard Total Stock Market ETF, VNQ is a cap-weighted fund, so the larger companies will make up a larger portion of this one. Think of the Vanguard Real Estate ETF as a fund of funds. That's because it holds stocks that are basically REITs. These REITs manage and develop basically every type of real estate that you can think of: construction, development, specialized, commercial, and residential real estate. A $10,000 investment in VNQ 10 years ago would have yielded just over $29,000 now. This ETF will provide you with a minor fraction of income in the form of 2.5% dividends and a stock price increase. It has a 1-year return of 31.6%, a 3-year return of 13%, a 5-year return of 10%, and a 10-year return of 11% thus far. And actually, only 6 investors have ended in a loss over the last 26 years. The biggest drop occurred in 2007 when VNQ fell by 68% and took 3 years and 4 months to recover. Any sort of property investment was hit particularly hard by this market collapse because the fall was triggered by that specific industry. VNQ is a low-cost investment with a yearly fee of 0.12% or $1.20 for every $1,000 invested. Because it's 100% stocks, Vanguard ranks this ETF as a 4 on the risk scale. If you hold something like an SP 500 ETF or the Vanguard Total Stock Market ETF and are concerned that too much of your money is concentrated in large cap stocks, then you might want to consider adding a small cap fund, like the Vanguard Small-Cap ETF VB, which is third on our list. This ETF has a goal to track small cap index US-based companies, which is well over 1,500 stocks. VB are stocks around $300 to $2 billion, which is already a lot, but if you compare it to huge companies like the large cap stock like Apple, which has a $2.8 trillion market cap, 2 billion sounds like pebbles. In comparison to an SP 500 ETF, a small cap ETF is considerably more volatile in the short run. However, historically speaking, these small cap companies have outperformed large cap companies over the years. If you invested $10,000 into the Vanguard Small-Cap ETF then, it may as well be $45,000 now. VB has a 1-year return of 22.5%, a 5-year return of 13.1%, and a 10-year return of 13.8%. But in terms of absolute domination, large cap companies do take the trophy. The Vanguard Small-Cap ETF saw its biggest drawdown of 53% in 2007 when it took 1 year and 10 months to recover. Vanguard Small Cap ETF is also inexpensive, coming in at a yearly cost of 0.05% or 50 cents for every $1,000 invested. The risk level for this ETF is on the high end at 5 because small cap stocks are naturally riskier due to their size and short-term volatility. Are you keeping up with the stream of information so far? If so, do hit the like and subscribe button before we continue. Growth stocks have been ruling the world over the past few years, so the fourth on our list is the Vanguard Growth ETF, VUG. Unlike VB, VUG tracks the Large Cap Growth Index. This is going to be made up of large US companies whose stocks are on the rise. And most of these stocks are going to be above average when it comes to a sound balance sheet, so the companies are pretty solid places. VUG currently holds 278 stocks, and the fund that it can hold within one individual stock is limited to 10%. A $10,000 investment into the Vanguard Growth ETF since inception would have then turned into over $74,000. With interest rates being so low for so long, it's really benefited growth stocks the most. VUG has had a 1-year return of 30.5%, 3-year return of 30.1%, 5-year return of 24.6%, and 10-year return of 19%. When we're thinking about the largest drawdowns for this ETF, the largest one came in 2007, where it dropped 47% and took 2 years to recover. VUG is extremely inexpensive too at a yearly cost of 0.04% or 40 cents for every $1,000 invested. The risk level is not too low, not too high. It's placed at a 4, which is to be expected since it only holds a basket of stocks, but not a 5 because all these companies are pretty large with healthy balance sheets. The sector is focused on technology, so when tech is down, VUG will be down as well because this is made up of companies that we're all very familiar with: Apple, Microsoft, Google, Amazon, Home Depot, and Visa. The last one on our list is going to cover the international money-making stocks across the globe, which is the Vanguard Total International Stock ETF, VXUS. This ETF seeks to track the performance of the global all-cap, example of which is the US index, which measures the investment return of stocks issued by companies located outside of the United States. There are a total of 7,800 different international stocks held within this ETF. $10,000 invested into VXUS since inception would have turned into a little over $20,000. VXUS has had a 1-year return of 11.4%, 3-year return of 10.5%, 5-year return of 9.5%, and a 10-year return of 7.3%. The largest drawdown for this ETF came in 2018 when it dropped by 25% and took 8 months to recover. Vanguard occupies the highest risk potential, which is at a 5. This one occupies the highest risk potential, which is at a 5, since this ETF only holds stocks outside of the US, and there's an inherent risk associated with that type of investment. This ETF is not centered on one particular area. It's made up of financial services at 18%, which is by far its largest part, followed by tech and industrials, both at 13%, and the Vanguard Total International ETF is mainly allocated in Europe at 40%, followed by emerging markets and Pacific at 26% and 25% respectively. For an investor who wants to diversify somewhere other than US stocks, VXUS is the perfect investment to make. While US businesses are the most dominant in the world, that could change at some point in the future. And there you have it, the top 5 Vanguard ETFs that you should invest in this modern time. I personally don't think that it's going to happen anytime soon, but let's be honest, crazier things could happen. Now is the time to explore waters that you're not familiar with and learn as you go. I do hope that you gained something by staying with me all throughout this video. Once again, hit the like and subscribe button before you go. See you!